This is the Texas Land Guys podcast, hosted by brothers Tim Dosch and Tom Dosch. With their partners David Marshall and Trip Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
All right, well, welcome to the podcast. Tim, it's exciting to do another one of these together. Today should be a fun topic. We're going to talk about a recap of 2024. It's hard to believe that we're finally into 2025, but 2024 was a really interesting year across the state. There's a lot we could talk about, and so I think this will be interesting. I don't even know exactly where we'll go today as far as what all we'll cover with just how big our team's gotten and all these different markets we're in. It's really interesting what we get to work on every day.
Yeah, maybe we can kind of start and back up a little bit and just talk about the cycle and where we are in the market from a bigger picture view. So if you look at, when COVID hit, we had kind of a short-term crash in the market in 2020. And then one of the biggest booms we've seen in the market, especially in Texas from 21 through 22, industrial really led that with incredible price increases on industrial land, a ton of industrial development. We saw, a lot of multifamily development in all the major markets, just some kind of record level pricing for multifamily land deals. And there's a lot of activity across all the use types except for office, which has really suffered after COVID and continues to be a kind of a troubled asset. So then what happened is the Fed started raising rates dramatically in kind of the summer and fall of 22, and really impacted our business and the development business as a whole. The pricing changed, cap rates changed, and we've had a really tough down cycle really from the end of 22, through all of 23 and into 24. And so a lot of these deals that were under contract in 22 fell out of contract, didn't get done. Some of them did, but the underwriting completely changed. And so it was just very difficult for developers to make sense of these deals. We started seeing some positive signs with construction costs coming down significantly for some asset types and land prices softening a little bit across some of the markets. And we felt like at the beginning of 24 that the market was going to shift and eventually the Fed would start cutting rates. And we thought sometime this year we'd see a recovery. We thought that would probably happen in the spring. I think a lot of our clients thought the same, that we would see a pretty strong recovery in the spring and summer. And that really didn't happen. There was a little bit of a false start. And that didn't happen until probably the September timeframe when we saw the Fed start cutting rates. And the market got very encouraged that, the light's at the end of the tunnel, things are going to get better. Tom and I have talked, it really wasn't even necessarily them cutting rates, even though that was a really positive sign. It was more that these developers have to do deals, and they'd adjusted to a higher rate environment. They figured out how to make deals work in a higher rate environment. And so rates being cut and construction costs being down just help deals make more sense. And so we feel like heading into 25, we're going to see a pretty incredible shift in the market in a very positive direction. And who knows exactly how it's going to play out. I think from an underwriting standpoint, there's still challenges, especially with certain asset types. And we'll talk about that later in the podcast. But we do see a big transition that's happened in the fourth quarter of 24 that's going to lead into, I think, a very successful and active 2025.
Yeah, that's a good summary. And, there's nuances to our markets, but I think that there are some things that were held pretty constant across the major markets in Texas this last year, just with multifamily and industrial deliveries down because of what happened with interest rates and cost of capital. And like you said, the cost of construction was so elevated in 2022. The only reason those deals were really working was you had lease rates and rental rates that were climbing at incredible levels. And then you also just had, really cheap capital that was available. And so when that shut off, we've seen a huge decline in deliveries. And so from a developer standpoint, what we started to see, and I think we saw this probably across pretty much all of our markets, was if you were going to get a deal done on the industrial side, it was going to have to be a really core location. Most of the activity pulled back in the infill, really proven areas. Prior to that, there were a lot of million square footers. There were big deals getting done up here in Dallas and some of the really far out areas that there hadn't been as much development. And when rates spiked, we saw pretty much all of those industrial deals fall out of contract. And then we saw a big shift in the market. And in 2024, a lot of the deals that got done are really small. So prior to 24, if you asked a developer on the industrial side, how much land do you need to justify an industrial development? It was probably 20 acres plus, ideally, maybe 15. And we did, and a lot of our clients did, deals as small as 4 or 5 acres. And these are large institutional developers, but those were the only opportunities that were available in these really core areas. And to your point, Tim, developers had to do deals. And so what's interesting about that in Dallas is we had actually a significant amount of deliveries in these more urban infill areas because so many of those smaller deals got done. And there really has not been much done out in the suburbs at all. And so when we talk about what we expect to see in 2025, I think you're going to see a shift there. And that there's always these corrections that happen in the business where, everyone's kind of reading from the same playbook. And so, everyone decides to come back more urban, and then, it leaves the periphery where there's just nothing happening. And so then it shifts back at some point. And I think we've seen something similar in multifamily. So I'd be interested to hear what you've seen in Houston, and I can talk about what we've seen in Dallas.
Yeah, and I was going to mention, just to kind of set up this conversation, it's an interesting conversation because when you talk about our market in 24 and looking forward to 25, I'm speaking sitting in Houston, which has its kind of its own market dynamic. Even though we're both in Texas, it's very different than Dallas. You're in Dallas, and then we have our Central Texas office, which is covering Austin and San Antonio. So I'll definitely get into multifamily. Maybe first, let's talk about the differences in those markets and just kind of high level, maybe where they stacked up going through this downturn in the market and where we see them, kind of coming out of it or maybe not coming out of it. I would rank, it's hard not to rank Dallas number one. I think Dallas has just been incredible from a population growth standpoint, job growth. You guys just keep getting all these, big corporations moving there. We're kind of jealous in Houston. Yeah, what you guys always are announcing in Dallas. Houston has been, probably the tougher market. I think going through the downturn, it just hasn't had the excitement around it that Austin and Dallas have had. I always say I think Austin is the new San Francisco. Capital loves Austin. We've seen just an incredible run, probably from 2020 on in Austin with across all the asset types on the single family side. Everybody's moving there. Pricing's kind of gone crazy. I think it's gotten pretty hot and maybe a little bit overheated in Austin. So I think we might see them slow down a little bit as they absorb all that's been built. I think San Antonio will probably do pretty well the next couple of years. Houston, because we've had such a slowdown in Houston historically, and we can kind of go through some of the numbers here in a little bit, but, in my career, it's been one of the most significant pullbacks in development in Houston that we've seen probably in the last, 20 years. There's been a couple times we've had similar pullbacks, but it's only been a couple times. And so the fundamentals are strong in Houston for industrial and for multifamily. On the retail side, there's a lot of positive momentum. And single family, I think it's been really hot. Actually, it's been the one asset type that's been super hot through the downturn. I think it might be slowing a little bit, but there's such a shortage of lots. I think such an opportunity there. I think it's going to still be pretty strong, going forward. So I would say maybe the last couple of years it's been Dallas, Austin, Houston, and kind of a ranking of activity. And we might see Houston kind of jump Austin and kind of get in that number 2 spot, at least for some time. But it just seems like Dallas is going to continue to add just a lot of volume. You're going to see a lot of volume up there from a deal standpoint.
Yeah, I agree with that, Tim. And I would say sitting in Dallas, but having worked in Houston, I have a lot of really interesting conversations with developers. It seems like there's a lot of developers from all across the country that have decided that Dallas is one of the top markets in the whole country to come and develop in. And a lot of them are not even considering Houston. And I think that we are starting to see more consider Houston over the last 12 months than we were. And so I would agree that I think Houston's probably moved above Austin, at least in the short term from a demand standpoint, because the fundamentals of you guys have just had such low supply numbers deliver. I mean, when you think about the population of Houston, population of Dallas, they're pretty similar. I think I just saw that Dallas is over 8 million people now, our MSA with Fort Worth. And, Houston's about 7.5. Austin and San Antonio combined are about 5.2. But Austin alone has had more multifamily deliveries than Houston and has a bigger pipeline of deliveries than Houston. So Austin, if you take out San Antonio, is, significantly smaller than the Houston market, probably a third of the size. And they have more deliveries and just more population, more population. Houston has more population to serve. And even looking at just the growth expectations, both Houston and Dallas are projected to be over 12 million people by 2050. And it'll take until about then for Austin to really hit, that similar number to where Dallas is now, which is a little over 8 million. And that's including San Antonio. So I think for that reason alone, Houston, just from a fundamental standpoint, is getting more attention. The challenge just seems to be that capital, really likes Dallas. And even though we have a lot of supply, just a lot more supply of probably every product type up here in Dallas, it just capital feels like it's a safer bet. And some of that's diversification. But I think we both expect Houston to really be on the rise this next year.
Yeah. So one interesting point that I made earlier, you kind of pushed back on, we could kind of revisit. When you look at Dallas and Houston, the differences, they're very different markets. So Houston has no zoning. Now we do have small municipalities on the periphery that do have zoning. So there are certain places that are hard to develop, but you could build a lot of units in Houston just because of the way we're structured. Really, the way we get held back a lot of times is utilities and just availability of land in the good markets. Dallas, on the other hand, has zoning, and you guys have some pretty restrictive municipalities when it comes to zoning for multifamily. I know that there's a lot of cities that are cracking down new multifamily deals. There's this opportunity with sites in the ETJ to kind of get around that. But I was speaking with a developer yesterday, and we were talking about Dallas and about barriers to entry and about, just the positive news of just the growth up there. And we felt like, it's hard to get hurt in Dallas from a supply standpoint because of those, encumbrances in the development. And you kind of pushed back on that a little bit as far as the reality of that. Do you want to kind of talk about that and the nuances of that?
Yeah, I mean, I was just saying that if you look at the numbers, I think that just because Dallas has zoning, or and I say Dallas, but DFW has zoning, it really has not restricted pretty significant supply numbers. And so when you compare, if you just looked at multifamily, when you compare Dallas and Houston, Houston's had about 26,000 units delivered the last 12 months. Dallas has had 40,000. There's 25,000 under construction in Dallas. There's 15 in Houston, and there's 85,000 in the pipeline in Dallas, which a lot of the pipeline, those deals, won't get built or may not get built for a long time. And the pipeline numbers a lot of times are just, there's no other place to really categorize deals that developers have purchased and are sitting on. Houston's pipeline number is about half. It's about 40,000. So a lot of that is demand, but it shows that, even though, and the same goes for Austin, you hear a lot of times it's really difficult to get projects zoned in Austin, yet you see a lot of deals getting zoned. And a lot of these municipalities that are further out, they're really big growth areas like Sherman with the conductor plants that's up pretty close to Oklahoma, or Salina, Texas, which is just north of Frisco. Basically, those cities, when the demand opens up and developers decide it's not too far out anymore, and there's reasons to go there, there's normally probably thousands of units of multifamily that are already zoned in those cities. And so that's what we've seen. I think in Salina right now, there's like 9 projects owned by developers just waiting to break ground when the market corrects. And so full supply numbers are pretty large in DFW. And I like to tell developers when they're coming from out of town and they say, what's the supply story? In Dallas, the supply story is normally not a good one. Almost everywhere you look, there's going to be deals coming. And, there's situations where maybe if it's a very built out area or just an area where there's almost no chance of getting a project done, that there wouldn't be much supply. But then normally in those cases, there's really probably no way to get a deal done. So everywhere that you would probably want to develop in DFW right now, we do see a lot of supply. That's probably the main negative for the DFW market, is just there's incredible supply numbers, and that's going to be a challenge for a lot of developers to figure out how to get capital on board. And we're going to need to continue to see population growth and the job numbers that you're talking about. We're going to need that just to see absorption and rents where they need to be to make these deals work.
Well, I think that's one of the reasons as a company we've really aligned ourselves around the residential use type and the industrial use type. Because you think about population growth in Texas, and you mentioned, both Houston and Dallas adding another, 4 million people or so each, in the next call it 15 years, or I guess you said 25 years, but still, I mean, we're talking about a lot of population growth. And when we say residential, it's single family, it's, build to rent, multifamily, all these different ways that, people have to live somewhere, and so I think we're very bullish on residential across the state. And then industrial, I just think with the way the market is shifting with all the e-commerce and just with the population growth, the need for more industrial is a big one. Not to say that there's not going to be a lot of growth in retail and the other asset types. We just see a big opportunity in industrial and multifamily. But also going back to the point you made about supply, I think it's interesting. You talk about like deliveries, which we know are actual deals on the ground. You talk about under construction, those are going to all be completed. So you can kind of drill down to those numbers. That's pretty black and white. I think what's interesting is the proposed pipelines. I think you said 40,000 for Houston, 85,000 for Dallas, and I'm sure that you could relate to this. When we look at the Houston proposed pipeline, there's, thousands of units that will probably not be built on that pipeline. Or you made the good point, they could be built. We just don't know. They're hard to categorize because there's deals that we did back in 21 and 22, that were very, big deals, high price deals that it looks like they won't be built. Because the developer bought at the top of the market, they can't capitalize the deal. They've been sitting on the site. It's going to be really hard to go put that into production. And so they may have to go sell it or maybe take a haircut and sell it. Maybe they'll figure out how to get it capitalized in the next couple of years. But there's a big percentage, and I think it's debatable how big that percentage is. You have to look at it a deal by deal basis and kind of make some educated guesses. But there's a piece of that proposed pipeline that will probably never happen or maybe push years into the future. Because we've seen some developers hold sites for 4 years or 5 years and then develop them. I mentioned a site earlier to you in the Heights that we sold. I think it was back in 2017, and it's just now being completed. It was bought for multifamily and it's being built for a seniors development. So you saw a use type change on the property and they held it forever, but it was a proposed multifamily deal in the Heights, for years, and it just never got built. And we see that across, really in the infill market in Houston, especially, but, also in the suburban market. I'm sure you're seeing that in Dallas as well.
Yeah, we definitely see that. And I think that there's unfortunately a lot of situations where when the market was really hot, you had developers coming in from out of state and buying several sites at once and just being very aggressive. In some cases we had some international developers doing that here in DFW. And, and then now they've pulled back out of the market. And so I can think as you're talking of a handful of developers that each of them has a couple thousand units that they own, but they've pulled out of the market. And so a lot of what we've been working on in 2024, because it's been really hard to make deals pencil, just the convergence of rates, being high. A lot of rents have softened across the whole market. And then you have high construction prices, which are just now starting to come down. It's been hard to make deals work, but the deals that have worked, a lot of them have been those situations. It would be a deal that was proposed that we're representing that landowner and selling it, or we're bringing a buyer into that situation. And so, it's going from developer A to developer B. So it'll stay on the proposed. It won't grow that proposed number, but maybe it'll make that more likely that deal gets built. And so, yeah, we definitely seen that. And I can think of deals in Houston that were on that proposed list 15 years ago, and they still are, because we talked about one the other day.
Yeah, it's crazy. I think you asked me a little bit earlier about just the Houston market and multifamily. So I'll go back and hit that now. I think what we've seen going through the last 2 years, it's been very difficult for multifamily development. I would say most of the developers pull out of the market, especially people that are out of state or kind of out of Houston, it pulled out of the market. And like you mentioned, Houston is not been a very attractive market, from a national standpoint. I think that there's an attraction because it's Texas and there's growth here, population growth. And so I don't want to say that there's not any attraction. We still have a lot of institutional capital, but relative to competing for money with Austin and Dallas, it's been tough the last 2 years. And so we've seen a lot of workforce housing or attainable housing in the suburbs. That's actually stayed relatively strong. There's been very little Class A suburban development. There's been some, but Houston's a market where we typically see in the better submarkets like Katy or the Woodlands or Cypress, we'll see some really high end, kind of three-story garden style or maybe 4-story walk-up product that gets built. And that really has been out of the market the last 2 years. Not 100%, but just very few of those deals getting done. But the biggest difference we've seen versus 21 and 22 is no infill development. I mean, as far as new land site purchases, there's a couple of deals under construction that were bought in 21 and 22. But I would say really going back to the Great Recession, this has been, probably one of the longest droughts for the infill market with just no activity, no offers, in some cases, sites that are good sites getting priced, pretty well. But the numbers just don't work. And developers have really, pulled back from those deals. They don't want to look at them. They don't want to offer on them. I think to some extent that's still the case, that they're hard to underwrite. But the encouraging thing we've seen this last quarter is quite a bit of activity in the infill market and developers looking at doing wrap deals again. For sure, if they can get a kind of a fringe infill site doing 4-story high density surface park deals. But even podium deals, which is kind of funny because in the last 18 months, one of our good developer clients told me, he's like, there's never going to be another podium deal built in Houston just because of how, they're expensive deals to build, you need really high rents. There's no way the numbers are ever going to work again. And you kind of know you're in the bottom of the market when people start making those statements. It's kind of like when oil went down in the 30s and people said it's never going to be $100 a barrel again. And then within 18 months, it's $100 a barrel. So this guy told me in the last couple of weeks, we have a site that we're working on that's a very well located infill site. And he said, I think that's a good podium site. And then we look at that for podium. We're going to make an offer on it in the next couple of weeks. So it just shows you how things change. And not that the deals underwrite that much better. I think that they do underwrite better today. But I think there's a lot of sort of forward looking at these developers saying, we think that things are going to get a lot better in the next year. And we're going to go, tie up some sites and start working on some of these sites because the fundamentals in the infill market are so strong right now. And I think there's going to be a lack of new supply no matter what happens. It's going to keep those fundamentals strong.
Yeah, and as you're talking, Tim, I'm thinking we meet with so many developers in all of our offices. I mean, any given week, we probably have, a couple developers a day coming in and meeting with us and talking about, industrial, single family, multifamily. But what's driving everything that you're talking about is capital and where capital is wanted to be. And I'm thinking about the deals that we closed in DFW this year or in 2024, it's last year. And, most of those deals, they were either workforce housing. So they were, like you said, very similar to what you're talking about in Houston. They're 3-story garden, multifamily, very basis driven, as low of a cost as you can build it. So a lot of almost kind of taking the production home mentality from the single family world and applying that to the multifamily world. So there were those deals, or they were well located tracts and it was private capital backing developers or developers with private capital. And they took the land down and, they're going to hold it until they can get a construction loan. And, it's interesting. In 2022, I had lunch with a big national developer. He said something very similar to what you said about the podium. He was like, I don't think we'll ever close on a deal again without a construction loan. We'll never close on a land deal again without a construction loan. And that's really what we started to see again in late 2024 was just, if it's a really well-located tract in a market like a Frisco, or a market like a McKinney, where, there's good rents, there's really good population growth, the incomes are really high, and we're seeing developers willing to go take the land down. And the same thing, if it's a core site, Preston Center, up here around our office in the Addison market, where there's just a lot of good growth, that's kind of what it's taking right now to get a land deal done is private capital to come and close. I know we meet with a lot of developers that give us a lot of very black and white statements like no one can buy that, no one can make that work, or my offer is the highest offer that owner's ever going to get. But we just have the advantage if we meet with hundreds of qualified developers across our offices and we see people do things and be aggressive at different moments in time, and we see capital events that drive decisions. And then now, we're starting to see some of these institutional groups like Carlyle get back into the market. Several of the deals we closed in Q4 in DFW, Carlyle was the capital on a number of them, backing different developer sponsors. And, what those all had in common was they were all the first type of deal I mentioned, basis driven, low cost, in a good market deal.
No, that's interesting. That's really interesting.
And I think, for industrial, it's similar. The industrial developers that have been tied to the institutional markets have really had a hard time in 2024. So we've seen a lot of deals go under contract and, quite a few fall out of contract. But then we've also seen, some real aggressiveness from developers that have private capital, deals that closed really quickly, like core sites becoming available around the airport that closed in just a couple months, where the developers just paid cash to take the land down. And so I think that that's what we're seeing right now. If you're going to take advantage of the fundamentals that you're referring to, you're going to have to have a capital source. And I think a lot of developers, that's going to be a struggle in 2025 is knowing what that capital source is.
Yeah, that's a good point. I think in Houston on the industrial side, we've definitely seen a resurgence in interest in offer volume and even just pricing. I think in the fourth quarter, we saw, probably starting in September and then going to October, probably in like a 45-day period, maybe a 30% or so, 20 to 30% increase in pricing. So we would be getting offers on a site, maybe you'd have one industrial offer. Next couple weeks, you'd have 4 industrial offers. And then the beginning pricing to where we saw pricing go was in that kind of 30% kind of increase range. And so when you see that kind of thing happen, the market's turning. And like you're saying, groups are realizing we need to go get sites. We can get the good sites can get capitalized. And in some cases, maybe go take a little bit of a risk on the land and control it, versus having to have everything lined up, for a closing. Although in Houston, we have seen sellers, be pretty flexible on timing if they can get to a decent price. They haven't been pushing as hard on quick timing on deals. It seems like in Dallas, you guys have had a little bit more aggressive timing, at least on some of the deals you guys are working on. Is that right?
Yeah. Well, the sellers are still requiring pretty aggressive timing in a lot of cases. Most of the developers are not able to meet that timing, or if they, sign up a deal at aggressive timing, they haven't been able to close. So really, most of the deals that have closed, except for the ones that are just core sites and the developers are going to close balance sheet, they've been longer contracts, and in most cases have closed in a construction just because that's really where the market's been.
I think one thing that's interesting when you think about the land market, you would expect a pretty big decrease in land values. And I'm sure you've had these kind of conversations with developers. We've had several developers in some of our listings just talk about the underwriting and say, hey, this site, it doesn't work at 0, or it doesn't, it works at 30% of, asking price. And I think sometimes developers have a perspective of the land needs to be valued at where the underwriting works, and it shouldn't be valued at more than that. And sellers obviously think differently. And you would assume that when you have these big shifts in the market, all of a sudden you can just go buy all these sites at these big discounts. And I think there's been some discounts in Houston and probably in Dallas. I mean, we've definitely seen some of that. But I think what's interesting, what we've always seen in downturns and what was held true in this downturn is the good sites, sellers typically just hold on to them unless they have to sell and there's some sort of a pain. They're not going to recognize a lower valuation just because that's what the market says in that moment that site's worth. They're going to say, hey, this is Texas. This is a good site. We know that if we wait a year, we wait 2 years, pricing will come back. Sellers obviously always have this belief that their site's worth a lot. And so they're big believers in their property and they'll just keep holding on so they can get their pricing. Did you see a lot of that in Dallas as well?
Yeah, we've seen the same thing in Dallas where, if you think about it, it does make common sense. If you don't have to sell, why would you suddenly sell when the market gets difficult? And so we've definitely seen that. And what we've seen to kind of prove that up is, some of the things that were being said in 2022, 2023, like on the multifamily side, developers saying, we're not going to get back to land prices at $30,000 a unit in the suburbs. And in the Q4 of 24, we had a deal that, went under contract at 30 a door. And now we're seeing several go under contract at 30 a door again. And so there was probably a moment in time where in some of these markets, pricing did come down 10, 20%. But, it's also artificial because if pricing was 40 a door in 2022, but it never closed, then you have to try to go figure out like what was the underwriting worked at 40 a door for a moment until rates changed. And so, it never really probably worked at 40 a door. Maybe the market was more like 30 and maybe in 23, 24, you could go buy a site in the mid to low 20s. But, we're already now posting numbers internally, offers made, activity on listings that are back to, 2022, early 2022 levels again. So that's telling us that things are really coming back from an interest standpoint from developers.
That's a great point. I think what people don't understand about land a lot of times is that there's not a lot of precision with valuation because every site's different and every site has its own kind of factors that are positive or negative that affect valuation. And so a lot of times you'll have a perception of a site or a submarket that land prices are in a certain value. So for example, in Houston, there are submarkets in the infill market where everybody thinks, well, land's worth 200 a foot or it's worth 300 a foot. Now, the reality is very little is ever traded in that price range. Maybe one deal is traded in that price range in that submarket. The land's not really worth that. But the sellers will hold on. They don't have to sell. They're just going to keep holding on and waiting for that kind of pricing. So there's very little trades in that market. And so you may have someone who has a site that is in that submarket who sells for 150. They think they just took a huge haircut on pricing. The reality is they didn't take a huge haircut on pricing. That's probably a pretty fair price for the property. And maybe it even was in the heyday when prices were high. But I think whether it's suburban market or infill market, sellers tend to have these really high prices, and then they'll say they're discounting it, but a lot of times they're really just pricing it at where the market truly is. And maybe it's even where it truly is in a good market. It's not like some great deal, but it kind of feels like it's on sale just because of how high the pricing was.
Yeah, it's a great point. And timing really has to do with that too. Just how much contract timing you're willing to give. A lot of sellers will think that if something's sold in their market, 200 a square foot, well, then I can sell my property in 30 days at 200 a square foot, but not knowing that maybe that other deal, not to mention the market it sold in, but maybe they closed and it took 18 months, and it was very efficient for a certain development. And so we run into that a lot where, especially in DFW, where we have a huge just investor kind of classification, there's a whole group of just a huge group of investors buying land in Dallas. I know you have investors buying land everywhere, but in DFW, it seems like compared to what we've seen in Houston, it's just a lot of different speculators, and they buy their sites normally on, a 30-30, a 60-30, a really fast timeline with the assumption that I can 2X this and I can do it and sell it on the same type of timeline. And so trying to educate them can be difficult that, I've heard it so many times. Well, I always close on a 60-30. So, Trammell Crow or Alliance or whoever the developers, they need to close on a 60-30. And yeah, as we know, there's very few development deals we've ever closed on a 60-30. They're just so much more complicated. And not to mention a lot of these land speculation sites don't have utilities and there's lots of issues, that come with them just because of the way they were purchased. But I think that you're exactly right. I mean, there's so much more that goes into valuing a piece of land. And if we're asked to value a piece of land, I always ask, well, how quickly are you expecting a closing? Because if you're gonna give 9 to 12 months, which is pretty standard to get like a maximum price, maybe it could be shorter depending on the situation. But if it's anything under 3 months, we're gonna have to apply a pretty significant discount.
That's true. And I think another big point is supply in that submarket. So if you say, hey, the site down the street sold for X, to your point earlier, if there's a big development on that deal, maybe a high rise or, some, mid-rise kind of development, you can only do so many of those in one submarket. So every site can't be a high rise or can't be a mid-rise deal, especially if one was just built, because that deal has to lease up and get absorbed. And even in the suburban market, we've had situations where you have several sites across the street from each other, and they all could be multifamily sites. Houston, there's no zoning. So sellers will think, well, why can't we just have 4 deals happen at the same time? And it's like, well, you got to get them capitalized. I mean, who's going to go invest in a deal when there's a lease up risk because there's 4 deals that they could potentially open at the same time? So understanding some of those kind of factors, or on the flip side, there's no supply and there's not a site across the street that could be, multifamily, then there's probably some better pricing you can get for that site because there's going to be a higher barriers to entry and less competition. And that goes for, industrial or retail or the other use types as well.
Let's talk a little bit about single family because I know we've like very, very briefly brushed on it, but really since interest rates spiked, that's been the asset class that's been really strong. What we saw in DFW was interest rates went up in, kind of the middle of 22. single family was actually the first asset type to respond. And so around that time, I even remember, I think it was maybe May of 22, we started to see single family deals falling out of contract. And then that number just snowballed. And so we had a huge pipeline of single family here in DFW that was built up. A lot of them were large acreage sites, a lot of communities that were going to be developed. And from really 22, probably May through the end of the year, most of those deals fell out of contract. And a lot of the big public builders just really pulled back. They got very conservative and they wanted to see kind of what would happen. And what's interesting is what happened was, so rates went way up. So mortgage rates went up. So then no one was selling their homes. And you really didn't have a lot of, people moving around. And so all these new home buyers or people that needed to buy a home, the inventory was just completely non-existent. And so these communities started posting really good sales numbers. So I remember in Q4 22, the numbers came out, they were good. And then in Q1 of 23, the numbers were good. And then all of those same developers that had dropped all of those sites, like some developers we worked with, they dropped everything they had, whether, deals with us, just deals across the market, thousands of acres, tens of thousands of lots were dropped. And so that had lasted about 6 months. And then the opposite happened. And then we just started seeing an incredible amount of activity on the single family side in everything from urban townhome interest to, suburban, developer lot interest to builders going in and buying sites and developing sites. And I think you mentioned it earlier, but that's really been the hottest asset type because there's almost been just like an unlimited amount of capital interested in these single family deals. And so we saw, I think, some shifts with that. And you mentioned it maybe slowing down, but that was a really interesting outcome of rates going up, was it actually had a very positive impact on single family development and deliveries.
That's a great point. I think to go a little bit even a step further, there is almost an unfair advantage that the public builders had because they subsidize rates for home sales. So, going through kind of the COVID boom, their margins went up significantly. I mean, in some cases, they doubled on what they were making per home. And so what they're able to do when rates rose is basically buy down the rate for the homes, still keep a good margin, but offer a buyer a really incredible opportunity because you can still get a low rate with them, buy a brand new home, where if you go and buy, the used home down the street, you're going to have to go get a rate at market, which was significantly higher. And so you're right. It was very counterintuitive because I thought, man, single family is just going to get crushed with rates going up this much. It's going to be devastating. But what actually happened is it was really one of the hotter single family markets we've seen. And I think across the company, we did more single family deals than we've ever done. I think in Houston, maybe by 2x or something. We have thousands of acres here that's either been closed for single family or under contract that our team has done. Everything, like you said, from these big, 1,000+ acre, 1,500 acre, big master plan community deals down to some really cool infill suburban and just kind of infill, higher density townhome or, patio home kind of developments. And I think when I mentioned it slowing down, I don't think we're going to see a slowdown in transaction volume. I think we might see just a slowdown how frothy it got from just some of the pricing that we were seeing paid. I mean, we saw in Houston single family builders competing with multifamily developers on sites and being them, basically paying more money for a multifamily site or a site that could be multifamily to do single family for sale price, which is just had never been, even a thing that we see in the market, out competing them. And that might slow down a little bit. They may have to pull back a little bit on some of the pricing, but I think there's still a huge demand for lots and for homes. And I don't really see that slowing down because I think we'll continue to see population growth.
Yeah. And I know another kind of interesting shift that I've seen just from being up here in Dallas the last 4 years is there's been several large single family kind of master plan Dallas developers that we've kind of sent down to Houston that are planting flags down in Houston now. And it seems like in DFW, there's just several really large master plan developers doing deals, and there were fewer in Houston. You had groups like Johnson Development that were almost like controlling the market back when I was in Houston. And now there's a lot of these new developers, new companies that are down, doing pretty significant deals, like you're talking about, thousands of acres in and around Houston. And so I think the single family world is seeing Houston as a big market, and it's interesting because when you have a population the size of Houston, but you're not seeing the apartment deliveries, you are seeing really strong single family deliveries.
That's right. Maybe as we start to kind of wrap up, we could talk about data centers because that's something you guys are seeing in Dallas. We're doing some Houston data centers, and then in Central Texas we are as well.
Yeah, it's interesting because, we talk a lot about like AI and we all know the need for storage, and that's only increasing. And, in a place like Texas where we already have a grid that's pretty taxed, and these data centers have incredible needs for power. And that's really the limiting factor in doing these deals, is finding sites, which is really where we're involved, finding land sites where you have power and, it's available, but also you have access to it. And so Dallas has had a huge amount of development on the data center side, especially South Dallas. And, we had seen that starting to trickle into Central Texas. There's some pretty large data centers that are under development, and you referenced it. We're working on several up here in Dallas that we're under contract on across the market. And it's really just trying to figure out, where can you find these land sites? For a landowner, a lot of times it's kind of like hitting the jackpot, because maybe you just own the tract, or, you bought it for single family development. If it has the right characteristics for a data center development, it can be like a 10x on what you bought it for, because some of these data center deals we're doing are 300, 500 acre sites, and they can pay really large numbers. It's not a per acre number. It's a per square foot number that you're paying on 500 acres. You're talking about a lot of what we've been working on are anywhere from $50 million to $100 million, land sites for data centers. But if you can get a data center there, these data center developments are billion dollar developments. So I think that's a really interesting asset class that's been around a long time, but it's changing a lot. And the need for it is, more and more, just with our needs on the AI and storage side.
Yeah, we're seeing it. It kind of surprised me because we're seeing it obviously in the suburban market and kind of the further out market, but also in the infill market. I think that's what really surprised me, is seeing these, really good infill sites that are typically, multifamily sites where a multifamily developer would pay up and build a structured parking deal. And we're seeing data center guys outcompete the multifamily guys and win out, in a bidding war and go get those deals if they know that they can get the power that they need. And so it's definitely a very kind of interesting new use type. I know it's maybe 4 or 5 years old. We've really seen it kind of come onto the stage here in Texas. But like you said, that they can pay more than anyone else if they get the right site. So it's pretty interesting.
Yeah, I think that's a true statement. If there's enough land there, we just have one here that was an infill site, and we were probably 15% higher on price. The seller ended up going with an industrial developer just because it was a quicker deal. And that's the thing with these data center sites a lot of times, is they're just going to be a little bit longer deals. And so if a seller is willing to be patient, like I said, you're always going to get a premium so long as it works out.
What do you see? I think on timing, there's like a range, so like one of the deals in Houston that we're working on is a relatively quick deal. It's probably a 6 to 8 month deal, contract to close for a data center. It's a smaller infill deal. But I know, some of these deals are 5-year deals, right? They can get pretty strung out as far as the timing.
Yeah, it all is going to just depend on, I think the deal you're referencing in Houston, there's already been some conversations with CenterPoint. And so there's already some knowns. I think if you're looking at just a raw tract of land and you have to do a load study, up here in DFW, you'd be dealing with Encore. In Houston, you'd be working with CenterPoint. And so it's a lot of it's just getting those answers. I think the most standard timing is probably somewhere around 18 months. If you don't have those answers to start and you just know that you're close to power and you're going to have access to power, and now you're trying to figure out what is the actual load going to be. And then I think you're referencing, we're working on a very large multi-phase data center development that it's so large that you're talking about 3 to 5 year type timeframes, just because you're going to be developing several data centers in phases. And so it's I think there's a lot that is pretty exciting about those deals, but I think there's going to be more regulation coming out around those deals as well, just because, like I mentioned, there's already some concern with just the grid in Texas, and can we handle the number of these data centers that are projected to open.
And the risk for the landowner and for the developer is you go tie a site up for a data center, and then potentially there's 2 other sites get tied up in the same area. Everybody's going after that same power source, and there's only enough, bandwidth for one of them. And so that could be an issue. You get tied up for 18 months or, some period of time. And if you hit it, you could hit it really big. It could be a multiple of what the value is, for another use. But if you don't hit it, you could be sitting there, with your property back in 18 months or whatever that time frame is, and have to go sell at a lower price for another use type.
Yeah, there's some areas that we're tracking where we know there is no more capacity. And so there probably won't be capacity in some cases for, 5 years. And a lot of those are the areas where you've just had all the development, or you'll see an announcement in, a smaller town outside of one of the big Texas markets, maybe a town you've never heard of, and they've got $1 billion data center coming. That's going to suck all the power for that entire area. So your point earlier, if you're a landowner and you hear that there's a data center coming down the street, it's probably not good for your land. You probably want to be the guy that has a great site and you have power going through your site and there aren't any data centers. And that's going to be much better than necessarily having one next door.
Yeah, good point. That's probably a good place to wrap up. We keep talking for the next, 45 minutes and going through. There's so much we could talk about with where the market is and where it's been, the last year and the last 2 years. But I'm definitely excited to be turning the page on 23 and 24. I'm proud of our company for how we performed through it. It was tough. Had some great clients that we were able to help out, and they helped us out by getting some good deals done. But looking forward to 25, and what in one of the next episodes we'll be talking about our predictions for 25, and we look at things kind of a year at a time, but also in cycles. And so I would assume that we'll probably see a pretty good cycle here for Texas. It's at least a 2 to 3 year cycle, hopefully longer, but I think we're on the front end of that.
Yeah, no, I think that's good. This was fun, Tim.
Yeah, that's great. Thanks, Tom.
Thanks.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.